This conference will now be recorded.
All right, welcome. Okay, so today's program is life and health policy provisions. Quite a few. Some of them are kind of standard, kind of common. Get the concepts down behind these provisions. Life and health are very similar. Well, I'll show you that. There's provisions in life insurance. You have the same or similar provisions in health insurance. All right. So let's get started. First of all, with life insurance, you have the insuring clause. Now, for the test, keep this simple. The insuring clause just tells you what type or what kind of policy you bought. That's how easy it is. You may get an exam question that says a clause that describes that an individual purchased a 20-pay life policy would be which of the following? Well, if it's saying he bought a 20-pay life policy, that's a type of policy. That's the insuring clause. Consideration is an exchange of value, right? Clients provide two things of value, information, right, and premium, and the company has to give something of value back, and they give a promise to pay should you suffer a loss. So that's consideration, kind of an exchange of value. That's more contract law, where there's got to be an exchange of value. Payment of premium says, well, again, part of consideration, you got to pay the premium to have the coverage, right? There's no such thing as free insurance. That's kind of an unfair trade practice, giving out free insurance to encourage people to, get a loan from you. So yeah, someone's got to pay the premium. Typically, whoever pays the premium controls the policy. The premium payer is typically the owner of the policy. Once in a while, the premium payer is someone other than the owner. Right? And so for my grandkids, my sons, they're the owners of the policies for a life insurance policy of my grandkids, but I'm paying the premium because I want them to make sure something's in place for that. What coincides with that is the ownership rights. Whoever owns a policy controls it. Now, usually the owner also pays the premium. The owner chooses a beneficiary. The owner chooses how the money is paid to the beneficiary. If it's a permanent policy, the owner of the contract can actually access the cash value. The owner can choose the dividend options if it's from a mutual insurance company that's a participating policy. So the owner really controls it. And the reason I have first party and third party, because it could be set up differently. First party owner is you, the insured, you're the first party to the contract. The agreement is between you and the insurance company. The insurance company is a second party. So if you own a policy on yourself that you're buying from an insurance company, you're a first party owner. All right. So, but my grandkids, okay, my grandkids are the insured. All right, they're the ones being covered by the policy. And so my sons are the owners of the policy. And since the owner is someone other than the insured, the owner controls it. All right. That means, yeah, the owner can access the cash value. They can change the beneficiary. They can choose to drop the coverage. Okay. They control the policy. And sometimes we have that, especially for estate planning, where you want to take the ownership of the policy out of your estate. Okay. Maybe transfer it to a trust or what have you. And that's where we have third-party ownership. And also the owner can transfer the ownership of the policy later on also, which we'll talk about, okay? Incontestability, your policy becomes incontestable after it's been enforced for typically 2 years. That means especially for life insurance, after 2 years, there's really only one reason the insurance company may cancel the policy, and that's because of non-payment of premium. Fraud is illegal, but in life insurance, you could actually get away with fraud, kind of. So suicide is a fraudulent act, but after 2 years, if the insured commits suicide, the insurance company is obligated to still pay the benefits to the face amount to the beneficiary. Okay, so in that case, you get away with fraud. And so the incontestable period is 2 years. If an applicant lied on the application in trying to obtain the insurance, and if they died within the first 2 years and the insurance company realized they lied, they can actually rescind the contract, cancel the policy, refund the premium, pretend like the policy never existed. But if they lied on the application saying they don't have cancer when they do, and they die from complications due to cancer after 2 years, they get away with the lie. The insurance company is obligated to pay the face amount to the named beneficiary. Okay. When I say face amount, that's the death benefit associated with the insurance. All right, so it's the amount of insurance that's paid if they die. You'll see face amount, you'll see death benefit, or amount payable sometimes is the terminology they'll use on the exam. Free look provision. The general free look period is 10 to 30 days. So when you sell a life insurance policy or health insurance policy, you're going to deliver it. When you deliver the policy, you're going to have that prospect sign a policy delivery receipt. They need to acknowledge that they received the policy. Now, when they receive it and they sign that delivery receipt, they either have 10 to 30 days to read the contract, review it. If they're not happy with the policy, the contract, you or your company for any reason whatsoever, they can cancel during this free look period and they will be entitled to a full premium refund. There is no obligation to buy. So anytime you deliver the policy, you want to get that policy delivery receipt signed because that tells us and tells them when that free look period begins. The general free look period, like I said, is between 10 to 30 days. Most people for life insurance is 10 days. Anyone who is 60 years of age or older automatically get 30 days. Anyone buying a Medicare supplement policy, they get a 30-day free look period. And anyone buying long-term care insurance at any age also get a 30-day free look period. All right. So that's what the free look provision is about. All right. Entire contract, I did pass that one. Entire contract provision. How did I pass it? All right, when you look at a contract, if you do have a life insurance policy sitting around, take a look at it. You typically have the policy up front and they photocopy and attach the application to the back. All right, so the policy and when attached, the application together, that makes up the entire contract. And that's what the entire contract provision is about. All right. Grace period. After the premium due date, there's additional time for the insured or the policy owner to pay the premium and keep the policy in force without a late fee and without going through a medical exam. In general, in life insurance, the grace periods, well, used to be like 10 to 30 days, depending on the policy. Now it's like 61 days. So the normal grace period is a 61-day period. So after the premium due date, your clients still have 61 days to pay that missing premium and keep the policy going without a medical exam, without incurring a penalty fee. Okay? If the client suffers a loss during the grace period, they're covered. Now, what some companies do is if a loss occurs during the grace period, they're going to pay the benefits of the policy minus the premium that should have been paid for that period. Okay? Now, if the loss, if the client doesn't pay the premium within the policy premium due date or within the grace period, then the policy will lapse for non-payment of premium. But if a policy lapses for non-payment of premium, well, they can then do what is called reinstatement. The owner of the contract or the insured can actually reinstate a policy by doing four things. Number one, they have to apply for reinstatement. Number two, they have to pay the past due premium that should have been paid. Number three, they got to pay a specific amount of interest on that past due premium that should have been paid. Okay? And number four, they've got to go through a medical exam because if their condition changed, the insurance company may not want them back. But if you qualify for reinstatement by passing that medical exam, paying the past due premium plus interest, you can actually reinstate a policy that you let lapse for up to 3 years. Okay? I got to be honest, it might be beneficial to reinstate an older policy versus buying a brand new one. See, when you reinstate an older policy, the premiums that you were paying when you first put that policy on the books, you're going to go back to those premiums. Versus if you buy a brand new policy today, you're older, right? And so you're going to be paying higher premiums from here on out. A lot of times with reinstatement, if the policy is over 2 to 3 years old, then the suicide and incontestable clause may no longer apply. Versus buying a new policy today, you got to wait 2 more years before you can jump. Okay, so and so there's some advantages, and also the longer you keep a policy on a permanent policy, a lot of times the cheaper the loan interest is going to be. So again, it may be worthwhile to reinstate versus buying brand new. Policy loan. For the policies that do build a cash value, your permanent policies, it gives the ownership or the owner of the policy the right to borrow from the contract, right? Anytime there is cash value. So you can take policy loans and withdrawals. Just for the test, keep it that simple. If it's a permanent policy, you can take loans and withdrawals from the cash value. All right. I'm not going to explain the difference. Well, yeah, go ahead. All right. You can withdraw up to the principal amount, which is the premium that you paid in. Okay. So if you, you paid $20,000 into a policy, it's a permanent policy. Let's say you have $30,000 in the cash value that's available. You can withdraw up to the $20,000, the premium that you paid. You don't want to draw that additional $10,000 out of that account, because if you withdraw gains from a contract, it becomes taxable. So you're going to withdraw up to the principal or premium amount, the $20,000, and then you loan the $10,000 gains so that you can access the $30,000 from the life insurance policy and not have to pay tax. All right. So just so you know, money that has already been taxed is called cost basis. So if you paid $20,000 in total premium into a policy and you have $30,000 in the cash value, $20,000 is cost basis. You can access that or withdraw that without any penalties. Okay. And then the $10,000 in gains, that's the tax basis. If you do drop the tax shelter and take that money out, then you'll have to pay taxes on that. So again, rather than withdraw the gains, just borrow the gains to avoid tax. All right. Now, another item associated with the policy loan provision, a very common test question, is most permanent policies do not have cash value till the end of the 3rd year. Okay, and they may phrase that a couple different ways. Right? In many jurisdictions, permanent policies are required to have cash value by the end of what year? And of course, that'd be the 3rd year. Assignment. Assignment is transferring the ownership of the policy from one party to another. Right? There's 2 different types of assignments. You have an absolute assignment and a collateral assignment. An absolute assignment comes into play with, well, my sons own a policy on my granddaughters. So they're the owners, my granddaughters are the insured. When my granddaughters are old enough and responsible enough, my sons can actually transfer the ownership of the policy that they have to my granddaughters. Okay, and so they're giving complete control of the policy to my granddaughters when they become old enough and responsible enough. So since they transfer ownership, whoever owns a policy now has to pay the premium. They can access the cash value. They can choose a dividend option. They can drop the policy, right? They have all the ownership rights. And then my sons, when they transfer ownership of that policy, they're totally out of the picture. They might still be paying the premium as a premium payer, but they lose ownership control. So always remember, whoever owns the policy controls it. Now, here and there on your exam, you're going to see something called life settlement, okay, or a viatical settlement. And if you see a viatical settlement or a life settlement situation, someone has a life insurance policy and they're diagnosed terminally ill. They need money, and if you need money, you may want to sell your assets. And life insurance is an asset. So in the time of need, they can sell that life insurance policy to an outside company who will pay them a percentage of the death benefit. So if someone has a $500,000 life insurance policy and they find out they're terminally ill, they have 2 years left to live, they can sell that $500,000 face amount at a discount. The viatical settlement company may give them, let's say, 70%. So they give them $350,000 in cash. And the owner of the policy then transfers that ownership of the $500,000 policy to the viatical settlement company. The viatical settlement company, since they own a policy, they're going to name themselves as the beneficiary. So they paid you $350,000 for this policy. You're transferring the ownership of a $500,000 life insurance policy on your life to them. They now control the policy on your life. They are responsible to pay the premium. Okay, and like I said, they're going to go ahead and name themselves as the beneficiary. So if you die within the 2-year period, which was the life expectation in that situation, they get the $500,000 face amount. Out of that $500,000 death benefit, $350,000 was their initial investment they got back. They realized $150,000 gain minus the premium they had to pay until you passed away. And so that's where that would come into play, where you're selling your policy, right? Selling an asset because you need the money. and that's an absolute assignment. A collateral assignment is where you have a life insurance policy. Let's say you have a $100,000 life insurance policy, and you're having a contractor come in and do some work on your house. And the contractor says, well, to remodel this kitchen, it'll be about $30,000. You say, great, I'll pay you when you're done. The contractor says, well, wait a minute here. You know, the last job I did, I completed the work. I was actually getting up in the morning to hop in my truck to go pick up the check, and I found out that they died. I never got paid for the work. And so we want to put something in place to make sure I get paid. And so you say, hey, I have this life insurance policy. So what you're going to do is you're going to go to a financial institution like a bank, and you're going to collateralize $30,000 of your life insurance to this contractor. So if they finish the work, all right, you pay them the $30,000 and you get these $30,000 ownership rights back. If you die, then the life insurance will pay them $30,000 that you owe them, right, to complete the work, and your beneficiaries get the remaining $70,000. And so you're using your policy as collateral. Now, this is a temporary partial transfer of the ownership rights, typically to secure a loan, maybe to secure some work done. That's where that may come into play. Not as common as you think, because most people don't realize you can actually do that with your life insurance. Right. So remember, absolute is a complete total transfer of the ownership rights, and a collateral assignment is a temporary partial transfer of the ownership rights. Right. Your policy may have a provision about misstatement of age or sex. Right. So if there's a misstatement of age or sex and a loss occurs, the insurance company will determine the true information, the true age or sex at the time of application, and adjust the benefits accordingly. That means the benefits could be adjusted upwards or downwards depending on whether it was an overstatement or understatement of age or sex. See, women statistically live longer than men, and so they pay lower premiums for a longer period of time. Us guys, we tend to die sooner, according to actuarials, because so we pay a higher premium for a shorter period of time. Right? And so if there's a misstatement of sex, excuse me, whatever's paid will be adjusted to reflect the correct information. Right. Conversion. This typically is associated with term insurance policies, to where you have a term policy and some companies will allow you to convert it to a permanent policy with the same company with the same face amount, no medical exam, just fill out a form and start paying the increased premium for that permanent policy. Right. That's one definition of conversion, which is convertible term. But another definition is taking your group insurance program, whether it's life or health or disability income or long-term care, and within 31 days, converting it to an individual policy without a medical exam. Right, so whatever benefits you had as an employee, if you get terminated or let go or laid off, you can convert your group insurance program to an individual policy within 31 days without a medical exam. You just got to pay the premium yourself if your employer was paying for it when you were working there. So that's kind of where the conversion situation comes into play. Okay. Medical exam or autopsy. If we, the insurance company, request it, we, the insurance company, pay for it. And so the background check and maybe doing a blood and urine test, right, to see if people qualify for the life insurance policy, the insurance company is requiring it or requesting it. Therefore, the insurance company pays for it. That means even during the free look period, if you choose not to take it, well, you got a free medical exam out of it. Also, at the time of death, if the insurance company requests an autopsy, the insurance company pays for it. Right, and it will be completed. So this gets a little bit tricky for some people. It's against their religion to have an autopsy done. However, this is a contract that will hold up in a court of law, and they purchase a contract and signed off on it saying they basically will, adhere to the conditions and provisions in the contract. And so if the insured passes away and the insurance company, the insurance company requests an autopsy, and the family says, no, it's against our religion to have an autopsy done, sorry, the insurance company won't pay out unless they have that autopsy done. Okay, so yeah, sometimes that pops up. It's very rare, but there's other companies that sell smaller fixed amount policies that adhere to the no autopsy situation. Okay. Beneficiary provision. Well, whoever owns the policy chooses the beneficiary. And we have two types of beneficiaries in general. Number one, revocable, and number two, irrevocable. When you see revocable, means you can change a beneficiary anytime you want. All right, one of your kids upsets you, you just write them right out of the policy, right? That'll teach them, right? That's revocable, just means you can change it anytime. Irrevocable means the beneficiary is set in stone. In order to change an irrevocable beneficiary, you have to have the irrevocable beneficiary's permission in writing to change it. Right. With an irrevocable beneficiary, that beneficiary is entitled to the proceeds of the policy. And so if you even wanted to take a loan from the policy, you would need your irrevocable beneficiary's permission in writing to take a loan. Because if you take a loan and don't pay the money back and you pass away, that's going to reduce what that beneficiary is entitled to. They may not want you to do that. Irrevocable beneficiaries typically come into play with a court order, maybe a divorce decree or estate planning. Right? So that's where it may come into play. So, right? But in most cases, we use a revocable beneficiary where the owner of the policy can change it anytime. As far as a succession of beneficiaries, if the insured passes away, the first one in line to claim benefits is called the primary beneficiary. Right? If perchance the primary beneficiary passes away before the insured, then when the insured dies, the money goes to the next in line, which is a secondary or sometimes called contingent beneficiary. Right? Some people even go so far as to name a third in line, a tertiary beneficiary. Although not commonly used, you could actually name as many beneficiaries as you want. And when you do name beneficiaries, clearly name them. Right? Don't say, John Doe is the insured and he's going to name his wife Jane Doe. There's a lot of Jane Does that could come out of the woodworks. And so you want to say Jane Doe, wife of the insured. Right? Or you can even put Jane Doe and list the social security number. So if something happens to John Doe, Jane Doe is going to get it, right? Because it's their social security number. In naming a beneficiary, you as a single individual buying a policy, you can name anyone in the world as a beneficiary. You just want to clearly name them. All right, so let's say, you're dealing with a client and their last name is Singh, and they want to leave it to their family member who has the same last name in Singh in India. Okay. There's, I hate to say it, there's a lot of Singh households in India. So we want to make sure that the right Singh family gets it. And so do us a favor, tell us where they are so we can make sure that if something happens, they actually get them in. The correct Singh family gets it versus someone else who has the same name that claims it. All right. So you do want to clearly name your beneficiaries, even with your children, right? Jack and Jill, who happen to be children of the insured or children of this marriage. Okay. And so, yeah, clearly name the beneficiaries and work with your clients on that. Okay. If you have multiple kids, you want them to probably share equally. Right? And so we're going to use what's called a class designation. And there's two types. Per capita, well, let's say you have 4 kids. Right? And you want them to share equally. So you can basically say class designation per capita, whatever the death benefit is, it's shared equally among the 4 children and no one else. That means if one of your 4 children pass away, then the money will be shared with the remaining 3 children and no one else. If 2 are your children predeceased, the insured, then the remaining 2, the surviving 2, will receive the proceeds 50-50. This one is the kind of the stuff the Hollywood movies are made of, where siblings are killing each other because the winner inherits the estate. That's the per capita designation. For STRPEs, yes, it's called STRPEs, I know it rhymes with Slurpees. No, for Slurpees, let's say you have 4 children, and if something happens, they're all going to share equally. They each get 1/4. All right. Well, let's say one of your children passes away, but they have 2 children of their own. Under per Stirpes, the money can filter through gaps in your family tree until it's all paid out. And so you have 4 kids, one of them passed away. The first 3 will share 1/4 of the proceeds each. The 1/4 that would normally go to your 4th child that unfortunately passed away, their portion will be shared among their children until all the money's paid out. So it kind of filters through, like I said, the gaps in your family tree. But per capita is immediate children only, absolutely no one else. And that's where that comes into play. This next provision is a little bit tricky. It's called the Common Disaster Clause. It's called the Simultaneous Death Act. It's called the Short-Term Survivorship Clause, or it's called the Time Clause. Right. So what you might want to, you need to get an understanding of this, and I don't have a visual here. I think it's in one of my recorded webinars, but we have an insured. Let's say John Doe's an insured. He's going to name his wife Jane Doe as the primary beneficiary. And then he's going to name his children Jack and Jill Doe as the secondary or contingent beneficiary. So John Doe's the insured, Jane Doe's the primary, and the children are secondary. Well, John Doe and Jane Doe, let's say they're going out on a date. They got date night, and they have a car accident. John Doe dies on the scene. Jane Doe surprisingly survives for 4 days and dies from complications due to the accident. Who gets the money from John Doe's policy? And most people will say, oh, the kids get it. And that would actually be incorrect. See, when John Doe dies on the scene, electronically or on paper, I guess, the money is paid to Jane Doe because she's his beneficiary. Jane Doe dies 4 days later. That means those assets are actually part of her estate, where even unsecured creditors can get paid before the children get any of the money. Okay, that's what normally happens if you don't have this provision in place. So with the Common Disaster Clause, if the insured and the primary beneficiary die as a result of the same accident within 90 days of the accident, we will basically assume that the primary beneficiary died first. So now when the insured dies and there is no primary beneficiary, the money goes to the kids. And so the Common Disaster Clause, or Simultaneous Death Act, is designed to protect what the secondary beneficiary would receive in the event of this situation. Right? That's what that's about. Right? You will get a question on that. It's very common. And for the test, it's typically 90 days to see who died first and make sure the money goes to the kids. Spendthrift Clause. This can be imposed on a policy. And where this comes into play is you're going to leave payments to a beneficiary. And when you leave payments to the beneficiary, you want to make sure that that beneficiary gets that money and absolutely no one else. Right? And so the Spendthrift Clause basically designates that you're going to make payments to this person only, and no one else can touch it. Not even creditors can go after it. Okay. Facility of payment provision. This is kind of on your industrial life policies, and it's still kind of, you'll see it here and there on some of your other policies, but let's say you are the last surviving person in your family. There's no other living relative. So if something happens to an insured, there's no living relative. Well, first of all, we're going to try and find the nearest living relative, but if none, we can actually pay to a friend or neighbor who covered the cost of the burial. Okay, so I should back that up. First things first, an individual dies and there's no surviving beneficiaries. All right, and if that happens, we're going to find the nearest living relative. And if there is no other living relative, then we can actually pay the proceeds to a friend or neighbor who covered the cost of the burial. That's how that works. Okay, so let me clarify that one. But yeah, it's kind of as a goodwill gesture to pay them for taking the time and energy to cover the Bureau. This came about back in the Industrial Revolution when we had industrial life policies. You know, typically 1,000 to 10,000 just to cover burial. Okay. Now, jumping over to the health insurance side, we have the NAIC model laws, National Association of Insurance Commissioners. And there are 12 mandatory provisions with respect to individual health policies, and there's 11 optional provisions. Now, you don't need to know the order of these provisions. You do need to know the concepts of the provision. I mean, the test isn't going to say, you know, mandatory provision number 3 does what? All right, they're not going to do that to you. They'll give you more information in the question. You know, mandatory provision number 3 concerning the grace period on a monthly disability policy would be which of the following? Okay, and then it would be 10 days. So, all right, but let's get into that. First things first, this is very similar to life. We have the entire contract. Remember, the entire contract consists of the policy and when attached the application. Okay. Any changes to the contract, well, the owner must be notified. Okay. The owner can request changes to the contract also. That's another avenue there. Instead of saying incontestable clause, in health insurance, we call it time limit on certain defenses. Your health insurance policy becomes incontestable after it's been enforced for 2 years. Now, whereas life insurance, after 2 years, there's only one reason the insurance company may cancel you out. Okay. Health insurance, there's 2 reasons. Number 1, non-payment of premium. Number 2, fraud. Fraud can void your health insurance contract anytime that is deemed fraud and can be proven by an insurance company. Okay, but remember, life insurance, after 2 years, you could actually get away with fraud. That's what that's about. Just like life insurance, after the premium due date, there's a grace period. That's a period of time to still pay the premium, keep the policy on the books. In the health insurance world, the grace period is dependent upon how often you pay your premium. So if you pay your premiums weekly, it's a 7-day grace period. If you're paying your premiums monthly, it's a 10-day grace period. If you're paying your premiums quarterly, semi-annually, or annually, then there's a 31-day grace period. Again, if you suffer loss during the grace period, you're covered. A lot of times the company will pay the claim minus the premium that should have been paid for that period. If you don't pay the premium by the end of the grace period, your policy will lapse for non-payment of premium. But again, just like life insurance, you can go through reinstatement. Remember the 4 things that you need to do to reinstate a policy. Number 1, apply for reinstatement, pay all the past due premium, plus interest on the past due premium, and go through a medical exam, or sometimes you'll see it as you've got to get evidence of insurability. And just like life insurance, you can reinstate a policy that you let lapse for up to 3 years. Okay, so again, life and health have very similar provisions. Okay. Still with these provisions, we have, first one is notice of a loss. That means if you suffer loss, you need to immediately notify your insurance company, typically within 20 days of a loss. All right, so if you did, slip and fall, break your arm, or suffer a disability where you're unable to work, you need to notify your insurance company right away, or typically within 20 days. Once you notify the insurance company, there are 3 things that are going to happen in the next couple of days. Number 1, actually the next 15 days, I should say. Number 1, they're going to acknowledge you suffer loss. Number 2, they're going to begin their investigation on the loss. And number 3, they're going to send you claim forms. That's this next one. This is the claim forms. If you don't already have them, you need to fill them out and submit them to the insurance company. You need to submit them with what's called proof of loss within 90 days of a loss. Now, in the health insurance world, you need to submit proof of loss within 90 days of a loss. In the property and casualty world, proof of loss must be submitted within 60 days. So remember, notice of a loss is just basically telling the insurance company you slipped and fell and broke your arm. Proof of loss is you have doctors' reports, medical statements, or bills backing up the fact that, yes, you broke your arm and this is the cost associated with it. That's the proof of loss. So notice is immediately, right? Sometimes you'll see in writing, okay? Proof of loss is within 90 days. Once you submit due proof of loss, okay, the insurance company should pay the claim immediately. That's what the time of payment of claims provision is about. The payment of claims provision is we're going to pay within 30 days, but who do we pay the claim to? So for life insurance, you have a beneficiary. For health insurance, you may have a choice. If it's a service plan, we pay the doctors and the hospitals directly. If it's a reimbursement or indemnity program, we pay you to pay the doctors and the hospitals yourself. Okay. And if it's a disability income policy where there's a death associated, well, then in some cases you will name a beneficiary on that policy and they need to pay. Just like life insurance, if the insurance company requests a physical exam or medical exam or autopsy, the insurance company pays for it. All right. Now, if you did everything you're supposed to, you gave notice of a loss, you submitted proof of loss, and the insurance company hasn't paid the claim within 60 days, you can actually secure an attorney and take legal action against the insurance company. But you cannot file legal action within the first 60 days after submitting proof of loss. When you submit proof of loss, you got to give them the 60 days to investigate the claim, right, to see if it's a legitimate claim. Right? So that's legal action. And again, in some of the health insurance policies like disability income, there may be a death benefit associated with it. And so the 12th mandatory provision is you can change the beneficiary. All right. Some other optional provisions is we have change of occupation. And this is a common one. I mean, if you have a very low risk occupation, you switch to a high risk occupation, I'm pretty sure you're not going to run out to your insurance company and say, hey, I've switched to an extremely risky occupation. Can you please charge me a higher premium for my insurance? Okay. And so if you don't tell us and a loss occurs and in the investigation we find out that you've changed to a more hazardous occupation, the insurance company can actually adjust the benefits. They would reduce them in that situation. Right? Now, if you're in a high risk occupation and you change to a low risk occupation, I'm pretty sure you're going to tell the insurance company, hey, I switched to a less risky occupation. Can you please reduce my premium? Okay, so we really don't have too much of a problem with that one. It's the other way around, going to a more hazardous occupation. Just like life insurance, again, if there's a misstatement of age, and this includes sex, right, then we will adjust the benefits to reflect the correct information. If you have two policies with the same company, right, then they'll basically determine which, there's a couple ways of managing this, by the way. Two policies with the same company, one will be primary, one will be excess. But if it comes out, what the company will do sometimes, if it's duplicate coverage, they'll just say, you know, which policy do you want to pay the claim? We'll keep this policy in force. We're going to cancel the other policy and give you your premium refund because you should not have two policies at the same time that cover the exact same thing. All right, that's where that comes into play. Now, if you bought two policies with different insurance companies, right, then one will be primary, one will be secondary. All right, one will pay first and then the other one pays secondary. Some companies, they'll coordinate benefits where they actually each share a percentage of the loss. So there's two ways of managing that. But again, I don't care how many policies you bought from one company or with multiple companies. You cannot make more money than the medical bills that you've incurred. Otherwise, that's a gain, and insurance companies do not give you gains. Relation of earnings to insurance, this is for disability income, that if you buy a disability income policy, you cannot earn more money from a disability than you would normally earn while working. All right, so that means if you had multiple disability income policies and each paid 60% of your wages, if you suffered disability and filed a claim on those three policies, you'd make more money sitting at home playing PlayStation than you would earn while working. There's no incentive to get healthy and go back to work. And so the insurance companies, they coordinate benefits. You cannot make more money than you would earn while working, okay? They'll limit what's paid. Unpaid premiums, remember, if you suffer loss during the grace period, we're gonna pay the claim minus the premium that you should have paid for that period. right? And that's kind of common actually too. So, right. As far as disability and health provisions, some other provisions we have is cancellation. All right, now the cancellation, we have 5 types of renewable or types of, I guess, cancelable or renewable contracts. And this list is listed from cheapest to most expensive. So with a cancelable policy, your insurance company may cancel your policy during the policy period, right? Anytime during the policy period with proper written notice. And so since the insurance company controls that, it's going to be cheaper to encourage you to buy it. Optionally renewable is a type of policy where the insurance company cannot cancel you during the policy period, but when the policy comes up for renewal, the insurance company reserves the right to renew you or not renew you, and they may not even give you a reason why they don't want to renew you. Again, since the insurance company controls it, that's going to be cheaper to encourage you to buy it. Conditionally renewable, just like the name implies, if you meet certain conditions, we'll renew you. But if you cannot meet certain conditions, then we don't have to renew you and we'll cancel the policy at renewal. Okay, again, we're not canceling during the policy period. We're just choosing not to renew you because you couldn't meet conditions. I had a client, he actually had a weight-related diabetes. If he's over a certain weight, his diabetes would kick in, but if he dropped his weight below a certain level, the diabetes miraculously just disappeared. And so it's a condition in his contract that on every renewal, every 5 years when he renews his policy, he'd come in, he'd have to hop on the scale. And if he's below the weight specified in the contract, they renew him for another 5-year period with no other questions asked. But if he ever came in and stepped on a scale and he's over the weight limit and set in the contract, the company can terminate coverage. Now, this condition is good for my client because it helps him maintain reasonable body weight, right, and keep the coverage. But it's also good for the insurance company. Anytime he comes in, he's overweight, they can drop him, which reduces the risk for them, right? And that's where it may come into play. Guaranteed renewable and non-cancelable are very similar in the respect that all you have to do is pay the premium. And as long as you pay the premium, the insurance company cannot change any provisions, terms, or benefits payable in the contract. The difference is guaranteed renewable means it renews every couple of years. That means when it renews, you're a couple of years older. And so guaranteed renewable, you're guaranteed to renew as long as you pay the increase in premium because you're older when you renew. Non-cancelable is a little more expensive initially, but your premiums will never change. All right. So guaranteed renewable is cheaper initially, right? But on every renewal, the rates go up because you're older. As long as you pay the premium, there's no medical exam. Non-cancelable is more expensive up front. Your premium doesn't change. All you got to do is pay the premium, you have the coverage. Now, a couple questions associated with this. One of your questions would be most policies, and they might even throw in most long-term care policies or most Medicare supplement policies are sold as which of the following? And the answer is guaranteed renewable. Okay. Number one is cheaper initially. Number two, it's got the word guarantee in it that people just seem to love. A different question says, with all things being equal, what should you, the agent, recommend? And you should recommend non-cancelable. Again, it's a higher premium initially, but the premium never changes, stays level for the rest of your life. All right. Now, getting into the senior years where you're switching over to a fixed income, living off of retirement, guaranteed renewable could eventually price you out of the market and be left without insurance. So non-cancelable, spend a little more upfront to have a premium that'll never change. So you can budget that. Right. And that's what that's about. Conformity with state statutes. Sometimes they change the laws. Okay. And your policy will have to conform to the minimum standards of any change in the law. Right? So you will be notified, right? But that's all that is. That means your policy will have to conform to the minimum change in the state statutes or minimum change in the law. All right? Illegal occupations is a common provision that says we will not cover you if you engage in illegal occupation. Okay? Which is optional. That's kind of funny to me. These are actually optional provisions. But that one's very common. Intoxicants or narcotics, if you're under the influence of alcohol or drugs and you're injuring yourself, it may not be covered. You'd have to check your contract to see if this provision was in it, because in some cases it's not. Benefit payment clause just says who do we pay the benefits to in the event of a loss. Again, this is with health insurance, you may actually have a choice. Service plans like HMOs and PPOs and Blue Cross and Blue Shield, the insurance company pays the doctors and the hospitals directly for the care that you receive. But with reimbursement or indemnity programs, which is more your major medical, comprehensive major medical, we can actually pay you the money to give to the doctors and the hospitals, or just to reimburse you because you've already paid the doctors and the hospitals yourself. So the benefit payment clause just says, who do we pay the benefits to? Who do we pay the claim to? And here, again, you might hear the word assignment. So remember, in life insurance, assignment means transferring the ownership of the policy from one party to another. But in the health insurance world, assignment means who are we assigning the claim payment to? I mean, who are we making the claim payment to? That's where that's about. Pre-existing conditions. If you have a pre-existing condition before buying this policy, a lot of times like long-term care, when you buy this policy, in the first 6 months, if you have something crop up or pop up that existed before you bought this policy, we won't cover it. Okay, so it's kind of sometimes called a probationary period. When you buy a health insurance policy, the first 6 months, we won't cover any pre-existing conditions. After 6 months, unless we exclude that condition, then we'll go ahead and cover it. This protects the insurance company from someone knowing they have something wrong with them, buying the health insurance policy, then when it's approved, then they file the claim. And this is a term that you're going to see called adverse selection. Those are high-risk people that are seeking and buying insurance coverage more frequently or more often than a normal person would. Okay, that's adverse selection. So the insurance company's job, the underwriter, is to kind of weed that out so the insurance company doesn't lose money. And one of the ways is having a pre-existing conditions limitation. Okay, and like I said, typically it's the first 6 months of the policy. We won't cover any pre-existing conditions that existed before you bought this policy. But after 6 months, yeah, then it's okay. Now you just got to hold out for 6 months, all right? So that in a nutshell is it. Do you have any questions on any of the material we've covered so far?
No questions at the moment. If I think, I will definitely reach out to you.
Yeah, not a problem, not a problem. Okay. So I'll go ahead and yeah, I'll put this on my website. After this meet, then I've got to, stop it. It's got to translate. Then I got to load it up to YouTube and post it. Okay.
Excellent. Thank you very much for the seminar.
Oh yeah, you got it. All right.
Thank you, Lauren.
You got it. Hey, good luck on you guys studying. And again, any questions, don't hesitate, reach out. Okay.
Will do. Thank you, sir.
All right.
Will do.
Thank you. Have a good night, you guys.
Good night.
All right.